Afternoon, everyone. Obviously, you're here today for the webinar on how we can maximise your allowances before the end of the tax year. So today, we're really looking at the allowances you have as an individual that you should be considering to maximise. We'll be looking at that in a detail and breaking it down into certain areas, getting close to the end of the tax year. Obviously, a lot of you have probably already been very organised and sorted out your self-assessments. If you haven't, you better speak to your accountant quick smart and get that all sorted so you don't have any fines. Today isn't about that. It's about, for the tax year we're in at the moment, are there any allowances you haven't considered using? How should they be used? And also a longer term strategy that can work alongside that. So, a little bit about Fusion.
Yeah, so Fusion Financial sits under the wider Fusion group. Within that group, we've got Fusion Tax, Fusion Accountancy, Fusion Recruitment, Fusion Law, and Fusion Financial. And the idea of that is that, all of these professional services people are talking to each other on the client's behalf. So, if you've got an engagement with Fusion Financial and there's a tax question that you may have, we can very quickly go to the Fusion Tax team and get some expert advice in that area. So it just sort of allows us to give you all of the information and expertise you need, regardless of whether we're the right people to help or someone else along the group.
And I guess, in quite a few situations, Josh, we've had that with our clients when there's been something that's come up in our annual reviews and we've been lucky enough to pull in one of the tax advisors for an initial 10 minutes.
Yeah.
And it's given us those quick answers rather than the traditional way of emailing another company that we've worked with previously and waiting for that response.
Exactly. Even to go back to the kind of self-assessment point, if your accountant is struggling to get information on pension contributions that you might have made in that financial year, then, internally within Fusion, our accountants ask us as the advisors and we give them that information as soon as we can. So, everything runs a little bit quicker, a little bit smoother because we're all working on your behalf.
And we've had a few of those this week
for
our clients from our accounting team. So here's the agenda for everyone to see, give you an idea of what we're looking at in today's webinar. Obviously, there'll be quite a big focus on pensions and family planning and ISAs and type of ISAs, and also some more targeted tax relief investments like EIS and VCTs. And then we'll also look at some other more general allowances that one should be considering, really use before that 5th of April deadline. My name is Neil Jacobs. I'm head of Fusion Financial. I've been working within the profession for probably over 20 years now. I have a large bank of clients I look after at Fusion Financial and work very closely with Josh.
Yeah, so I work here at Fusion Financial as a financial advisor. I've been at Fusion for 5 years, and before that, I started my career offshore in Barcelona working with British expats who are looking to relocate outside of the UK. So that's given me a good sort of understanding of cross-border financial planning, as well as specialising with UK companies here in the UK or, just private clients who are looking for financial planning solutions.
So the end of the financial year is obviously getting really close. We want you as individuals and potentially business owners to really focus on what allowances you haven't used yet and consider those that you may be in the situation where you can still make use of. You've got obviously your pension allowances, your ISA allowances, but there's other allowances that people don't always think about, like your capital gains tax allowance, which obviously we know has reduced quite a bit over the last few years. But I'd say at the moment it's just about at the level where you could probably top up an ISA from, let's say, a general investment account using that capital gains tax allowance. Also, how to structure your income and certain investments that may help you keep within certain thresholds. And then there's other ones like your inheritance tax. There's small allowances within that, like the £3,000 you can use as an individual. And if you didn't use it last year, you can actually carry it forward. So hypothetically, you could actually get away with gifting 6,000 without having to use the 7-year countdown. Anything you want to add here?
Yeah, I guess just, in terms of, going to the income tax allowance, there are certain points along your earnings journey where you will start to lose different benefits available to you. So, incorporating things like pension contributions is a good way of bringing your overall income down for the year, which will then restore some of those allowances that may be lost along the way. Things like, childcare allowance or, the tax trap where beyond £100,000, there's a marginal rate of 60% because you start to lose that personal allowance. So it's just understanding how the, all of these things, the pension contributions, ISA contributions can help you in your overall financial journey.
And we've found a lot of our clients who that never affected because obviously they've frozen a lot of these bandwidths on the income tax, that every year more people get brought into it because their companies are still giving them an increase. So where it wasn't a problem last year, suddenly they're faced with seeing some of that personal allowance lost or potentially that child tax benefit that they always used to receive has suddenly gone because they've started to earn above the allowance that would give you that benefit. So good planning will ensure that these benefits potentially could stay within the remit for you as an individual. Now, one of the obvious allowances that is not only tax efficient for the here and now as a business owner, but also as a personal individual is your pension. You have an annual allowance of 60,000. A few years back, it used to be 40,000. The last 2 years, it's been 60. Next year, it will be 60. So effectively, you can make a personal contribution of up to £60,000. Or if you haven't made certain contributions in previous years and used your full allowance, you can use something called the carry forward rules. Hypothetically, if you've got a pension already set up and you haven't made any personal contributions or company contributions into that pension, you could potentially make a £220,000 contribution into that pension. Now, the restrictions on that, I would say a high level point of view would be if you're making it on a personal level, you'd have to be earning at least what you're contributing in. That's the obvious one. But if you're a business owner or you have a very generous, bonus or boss that wants to make a big contribution into your pension, then you can go beyond what you earn as salary, but not go beyond the carry forward number, whatever that is, once we work out what contributions have been made in previous years, plus the allowance for this year. Now, there are things you need to take into account now because there are tapered allowances, so that contribution can go down if you surpass certain thresholds. And also, can you make the contribution through your employer or through personal contributions? And obviously, doing it through your employer, definitely for the here and now for this tax year, is other benefits like salary sacrifice, so it really comes off the gross, or your employer makes the contribution on your behalf and effectively reduces your salary to counteract it. These are really useful tools in helping you, like we were talking before, keep your personal income within certain thresholds. Now, it's all good and well making these contributions into a pension. They are tax efficient, but what's the point of it? Well, the point of it is it's a very tax efficient way of getting money out of your business into your pension or getting money from your salary into your pension for the future. So when you come to retire, you've got a decent sized pot to enjoy your retirement. Now, I would say that it's something that you should be trying to start as early as possible. and to get the right behaviours into place. And on top of that, once you know you've got those behaviours, it's also having the correct strategy. And the way we can help assist with that is using tools like cash flow forecasting and Monte Carlo. So if a client's sitting with us and wants to make a contribution of £20,000 a year into their pension, what does that mean for them when they hit the age of 57, or if they plan to retire at 67? What will their pension pot look like? What tax-free allowance will they have from that pension potentially? How can they take their pension? What are the options? And what does their retirement potentially look at? I would say Josh and myself, when we use cash flow forecasting with our clients, it definitely gives them a better idea of why they're doing it, rather than us just saying it's tax efficient, so you should. It helps them really get a good view of what their retirement could look like. And if they're not happy with that, what potential contributions should be made to achieve their goals and aspirations. Is there anything you feel I need to add to that?
Yeah, I think just as if you're someone sitting there who has already started drawing from the pension and you're thinking, can I still contribute back in? Then you can, but you don't have the full £60,000 allowance that you had when you were, before you started to take your pension funds. That reduces to the £10,000 money purchase annual allowance. So even if you've already started taking from your pension, maybe you're still taking and you just want to contribute back in, or you took a one-off payment previously and now you've kind of gone back to work, or you've got this extra cash that you're not sure what to do with. You can pay that back in, but only up to that £10,000 money purchase annual allowance. And I think the other thing to note is these allowances and this tax relief is great, but it's important to remember how you get it back, right? Because if it's coming from your employer who's paying your pension straight into your work-based scheme, then the likelihood is you'll already automatically be receiving the tax relief. But if you're somebody who wants to make a one-off additional contribution, not coming from your normal employment, then the way you do that is to pay the money in within the pension scheme. You'll get an automatic 20% tax relief on that contribution. And if you're a higher additional rate taxpayer, then you need to make sure that you record that contribution on your self-assessment at the end of the year so that you get the additional 20 or 25% relief back. So there's just a few kind of logistics which a lot of people don't know about when they're making those additional contributions. And so if they're an additional rate payer, they only ever receive the basic rate relief rather than the additional or higher rate relief because they weren't sure how to claim it back.
Can I just add to that from a case you and me worked with a couple of years ago where we took over a scheme for a company. So we're not giving personal advice here. We're looking after a company scheme. And some of the staff who were higher rate earners did not realise that with this particular scheme, that the higher rate earners actually needed to claim back the additional higher rate tax benefit through their self-assessment. For many of us in pension schemes, we don't need to worry about that. It's all done through the employer, through payroll. But with some schemes, you have to do it through the net pay strategy, which means basically doing it through your self-assessment. So I would definitely say don't assume that that's the case for you. Ask the question to your HR. You can claim for a number of years if you've missed out. It can really add up over the years, and we've helped a number of the staff there claim back previous years' tax breaks that they missed out of because they didn't ask the question. It was in their contract. They were made aware of it, but let's be honest, once you're working and focused on your day-to-day, sometimes things like this can pass you by. So just something to bear in mind.
If you're sat there thinking, that rings a bell, maybe, I made a contribution and I didn't quite claim back the full relief, then, it's not a huge worry. You can go back up to 3 years previously to reclaim that. You can't do it through your standard self-assessment. You need to, write to HMRC direct. But, if that's something you want to discuss, maybe you're thinking, I'm in that position, then, we can help you sort of, plan to get that relief back eventually.
Yeah, we've done that a few times.
And then that kind of brings us to, that next rundown on the tax efficient savings, allowances that we have here in the UK. And I think the UK, for all the sort of negativity it gets, this ISA allowance of £20,000 per year is one of the most, tax efficient ways of saving, across the world, right? You've got a full allowance of £20,000 that you can either put into a cash ISA or into a stocks and shares ISA. And if it's in a cash ISA, the interest received within that ISA will be tax-free. And if it's in a stocks and shares ISA, the growth on any of those, assets that you're invested in will also be received tax-free. So it's a very tax-efficient way of growing your funds year after year and putting in the right contributions with that excess, the excess funds you've got after your income, after your expenditure, beyond your emergency fund. Now, if you end up in a place where you've utilized the full ISA allowance and you've got children, well, that's when you can start to think, how else can I make tax efficient savings? And one of the ways to do that, if you want to start supporting your children for the long term, is through a junior ISA. Now, the allowance is lower than for the standard ISA, but it allows you to pay up to £9,000 each year into your child's ISA account. Now, the good thing here is they can't access that money until they turn 18, right? So there's a long time horizon, especially if you start early, for making these contributions, seeing the compounded growth over that period, so that when they turn 18, there's a nice pot of cash or, investments that are there that they will then convert to a standard ISA. Now, the good thing there is that because they can't access the money until they're 18, there's no risk of them spending it. Some of you may be thinking, 18, not sure I'd want my children to get access to all of those funds when they turn 18. That's very true. And, that kind of situation that you find yourself in when they turn 18 comes from education for your children and making sure that they know what this money represents, right? What is it for? Is it for a future property purchase? Is it for paying their student loan fees? All of those kind of things. But it's about, building that, talking with your children to understand this is why we're putting money away for you, for your future. It's not so that when you get there, you can spend it on, lavish items, right? Beyond that, I think, the ISAs represent you. And if you're married, everybody gets an individual allowance. And it's just a really good way of making sure that any savings you've got are growing tax-free.
I would say if 20,000 sounds like a lot to any of you watching and listening to this, then just utilize what you can afford. It will definitely benefit you in the future, that compounding. And if you're lucky enough to feel like 20,000 feels like nothing, it's 20k. I can do that with my eyes shut. What's the point? You really should, because over time, with that compounding, it can quite quickly turn into six figures. And as we well know, over the years, we do have a lot of investors these days with seven figures in their ISA. And having that sort of money in an ISA, where effectively you can get growth tax-free, income tax-free, whether it's a few 100,000 or substantially more, is a really good tool for future planning. And as an advisor who works with a number of clients who've always utilised their ISAs and had younger children, I've seen that journey, and Josh has seen a few of them come in where we started the junior ISAs years ago. We've now got some of these children who are 18, some of them 21, 22, and we'd already brought them into the picture if they were interested with education within Fusion Financial, getting them to understand what we're investing in, why it's worthwhile. And it's about helping the children have the right behaviours that they just don't learn at school. Have them at an early stage, get them to understand why why their parents are doing this and we're facilitating it, give them a level of empowerment. And if they're interested in their 18, 21 to be a bit more involved and have meetings with us as the advisor, we're all for it. It's a great thing working with the family.
Yeah, and I just think, one of maybe the barriers to entry or, hesitancies around ISAs is, people get confused because there's lots of different types, right? There's a cash ISA, there's a stocks and shares ISA, there's a lifetime ISA. It can become a bit of a minefield in terms of what is the right one for you. And just because, it's labeled as a stocks and shares ISA, that doesn't mean that every pound that you put into the ISA is going to be invested in the stock market, right? It's just the title of the ISA. What goes into the underlying investments will be decided, if we work together, we decide it based on your own individual risk profile, right? Are you risk averse? If you're risk averse, just because it says it's a stocks and shares ISA doesn't mean we have to put all of the funds within the ISA into stocks and shares. We can be invested in something lower risk than the stock market, something like a bond fund or a gold fund or a property fund. There's no end to the asset classes that we can invest in really within the ISA, but that headline of stocks and shares really puts people off if they're not comfortable with investing. Likewise, a cash ISA can also put people off because, they may see sort of 4%, 5% as the headline figure and think, what's the point? I'm getting that with my bank anyway. Well, if you're getting it with your bank, you may be in a place where the interest accrued on the savings there with your bank are paid to you beyond your personal allowance, and you start to pay tax on those returns. So, even if you want to sort of go into a short-term savings account for cash, the ISA is a good way of doing that because it's protected from the tax.
Josh, I'm a potential client of yours. I'll sit with you. I've got 100k I've actually built up in cash ISAs. Funny enough, in the discussion you and me have, I have no plans for this money, and you find out I've actually got some savings elsewhere. Am I stuck with this cash ISA because I can get 5% with Barclays deposit account, and I'm only getting 4.5% on this cash ISA? I've got no plans for this money.
No. So what you can do, if you're in a place where you've built up ISAs over time, and they're either sat in cash and you no longer want to be in cash, or they're sat in a stocks and shares ISA and you're thinking, I keep hearing, markets have been strong, but I'm not seeing any real returns on my account. You can transfer your already set up ISAs into another account. Now, the reason to do that would be if you're in a cash ISA and it's no longer relevant for you, you no longer need, in Neil's case, £100,000 in cash ISAs, you could transfer that to a stocks and shares ISA. And when it's in the stocks and shares ISA, we can work out what's the right level of risk to be taken, what is the right investment to be in, so that we can plan the long-term sustainable growth that you will get. Now, the likelihood is over a longer period of time, we're going to see higher returns in a stocks and shares ISA than a cash ISA. Now, it's going to be dependent on the underlying investments, but that would typically be the case, which is why for short-term funds, a cash ISA is going to be great. For longer-term funds, which you don't have any real plans for 3, 4, 5 years, that's when we can start talking about, is a stocks and shares ISA the right vehicle for you?
Brilliant. Thank you.
And that brings us on sort of to the next one, which is, these tax advantaged investments that are available to people. Now, if you're someone who's maximized their pension contributions, maximized their ISA contributions, even, paid into the junior ISA, and you've still got excess funds, enterprise investment schemes and venture capital trust investments are a very good way of receiving tax relief on additional investments. Now, why is that? Well, that is because both of these vehicles allow you a 30% tax relief on the way in, right? So if you had £100,000 that you had surplus cash to invest, you'd already maximized your ISA and your pension, and you put this into a venture capital trust, you'd be able to receive £30,000 income tax relief when you do your self-assessment. Now, there's a caveat to that in that you must have paid at least £30,000 tax to begin with, right? They're not going to pay you, in addition to tax you haven't paid. But if you're a higher rate taxpayer or additional rate taxpayer and you've got excess funds, you can pay into these vehicles and receive income tax relief back. Now, other advantages, and I'll just break it down between sort of the venture capital trust side, which I'd say is, as much as it's high risk, it's lower risk than the enterprise investment scheme side. But for the venture capital trusts, if you're invested and they pay out a dividend, those dividends come to you tax-free. So you don't have to worry about dividend tax. Those dividends are paid to you tax-free. So as a long-term income planning strategy, if you build up a nice sized pot within a venture capital trust, over time that's going to pay you dividends and they're going to be received into your account tax-free. Now, what else? Any sale on the venture capital trust, as long as you've held it for 3 years, is going to be capital gains tax relieved. So there's going to be no capital gains tax to pay. And then moving to the enterprise investment schemes, this is a really inheritance tax efficient way of investing, because after you've held your investment for 3 years, it's then outside of your estate for inheritance tax purposes, right? So if you end up at the end of your life with £200,000 of enterprise investment scheme, funds, that will not be taken into account when it comes to doing the inheritance tax calculations, because it's so tax advantaged in the first place. Now, the reason that these advantages exist is because these investments are really based on scale-up, startup, UK-based companies, right? And so the government has a mandate to sort of get people invested into UK-based companies, and this is a really good enticement for people to get involved. Now, that comes with its own risks, because a lot of these companies are small scale-up startup companies, and they may not go the distance. But what we want to make sure is that you've got a real diversified portfolio of different types of company that you're invested in, so that the risk of default across the portfolio is low, and that we can sort of plan for some of these companies to do exceptionally well, some of these companies to tick along as planned, and some of them to go out of business, because that's the nature of this type of investment. So it's not for everybody, but if you've got excess capital and you want sort of to have a conversation about tax relief systems, this is one way we can talk about it.
Obviously, we've already brought up about the capital gains tax allowance, which is effectively 3,000. But if you are married, you can times that by 2. If you've got investments in place and they're in single names and you are married, it's worth having that conversation. Well, maybe potentially with yourself. Is it worth me turning this into a shared account so I can benefit from that exemption times 2? And that will give you more flexibility on some of the profits. Obviously, we've got dividend allowances you can use each year. So when you set up your investments, some investments, if they're distributing the dividends out, you can utilize that within your income each year and not pay tax on that part of the allowance. We've already touched briefly on the gift allowances, and obviously if you haven't used it in the previous year, you can carry that forward for 1 year. Again, really useful on birthdays, or if you're hitting a certain age and you want to slowly over time reduce your inheritance tax liability on your family, then using those annual allowances, plus when you've got family that are getting married, obviously if they're close enough, you can make a substantial contribution there. So all of this are things that are available to you and worth utilizing depending on what you're trying to achieve. I'd say when it comes to financial planning, we try and utilize the capital gains tax allowance best we can when we're topping up investments each year. But for a lot of you that are in property, it's it just doesn't hit the side. But when it comes to topping up your ISA, it can be used each year, and before you know it, you could have hundreds of thousands in your ISA over a number of years, which is a very tax efficient investment, which you can have some fun with. There are investments out there that are a bit more risky if you want them to be. And like we were talking about before, about diversification, it's all about what your appetite is. So if you are someone that likes the idea of having a certain amount in your ISA in tech or pharma, then these are things you can look at and put a percentage in, and utilizing that capital gains allowance to build up your ISA over time is really well worth it. I would say getting a clear picture of what you're trying to achieve and putting it down on paper, whether that's with an advisor using cash flow forecasting or you as an individual effectively just taking a step back and thinking, what do I want to achieve? When do I want to achieve it by? and what do I need to get there will definitely help you consider what of the allowances we've gone through today are worth you really trying to maximize. And then it's about affordability. Number one, get the right behaviors in place. Once you know you've got the right behaviors in place, please make sure you've got the right strategy in place, because with the right strategy and the right behavior, you're going to give yourself the best fighting chance of achieving your goals and aspirations. And while doing that, also ticking the box in what this webinar is all about, which is using all those allowances.
Yeah, good. And people talk a lot about compound growth and investments compounding over time, but I think what's less talked about is small allowances compounding over time, right? And if you start to do these things year after year, then long term they'll make a big difference to the financial plan, right? So I think although it may seem like a very small thing that you're doing, if you're trying to sort of use your dividend allowance or use your capital gains tax exemption, if you do that year after year for a sustained period of time, you're going to put yourself in a much better position long term than if you don't do those things. Just to kind of touch on how you can incorporate, if you're a small business owner, small medium-sized business owner, or a director of a company, how you can incorporate these allowances to that as well, because you might be sitting there as a business owner with a financial year end which doesn't quite match up to the tax year end, right? So the tax year end is a very important date, because it's the date when things like your annual allowance stop, right? If you haven't made your contribution of £60,000 up to the 5th of April, then there's a new year on the 6th of April. But if your financial year end runs from January to January, then you're going to be in a case where you can almost benefit from 2 tax years, right? So if you're a company who hasn't made a lot of pension contributions in the past, but you're sat there with some excess cash from some excess profit, you may be in a place where you can make beyond a £60,000 contribution. Now you can do that because you'll be straddled over the tax year end deadline, and so you can use 25, 26's deadline, and as you go into 26, 27, you've also got that allowance to use as well. So I think if you are a business owner, there's a lot to talk about to maximize these allowances that are available to you as a company, as well as the personal side that we've already discussed.
There's one area that's actually, it's not really anything to do with the year and the allowances, but it is an allowance that HMRC give businesses, and that's franked income. If you're a business owner and your business is looking very healthy, you've got good growth, and you're sitting on substantial amounts of money within the business that is just sitting there on long-term deposit accounts, and you don't need it for reinvestment, I'd strongly advise you, I don't want to go into it in a lot of detail for this webinar because it's not the point of it, but give Josh or myself a call. We'll just educate you on what this is in a bit more detail and how it would benefit you as a business. It's something we do for a lot of our clients, and it's really tax efficient, and it allows dead money in the business to grow really tax efficiently and stay within the business. Anything you want to add to that bit?
No, I think you're worth having that conversation if you're a company sat on cash which isn't needed for the now or the immediate future. What is it doing for you? Because not every pound can be reinvested within your business, and not every pound can be distributed either via dividends, salary, or pension contributions. So anything that is left, let's have that conversation about long-term investments within the company so that you're maximizing the value of every pound in your business.
Brilliant. Thank you, Josh. So obviously, as we're getting really close to the end of the tax year, take that step back, have a look on Google, look at the checklists that are available, or if you've taken notes from today, just think about what contributions are you making. Some of you may be doing monthlies into your pension on a personal level or through your employer, or you may be making ad hoc or personal monthly contributions into your ISA. So just take a step back, spend an hour on it, and look at what have you maximised so far, and is there a gap still where you could really top them up? Like I said earlier, you don't need to use the full allowance, but whatever you can afford to do, if it's medium term, the ISA allowance is going to be a really big focus for you. If you're less concerned about the longer term retirement planning, and if you can utilize them all, then I would say, just try and maximize best you can. And then formulate that long-term strategy within that. What is the ISA for you? Is it just to build your wealth? Or are you building something to pay for an event in the future? And then build that plan. And it's hard to always be able to do that when you don't know the investment strategies in place and how the compounded potential growth can work. So we've got all those tools at hand to help you with that and assist you in having that right long-term or medium-term strategy that will fit with your yearly tax planning.
Yeah, and I think if there's one thing that you can do sort of off the back of this, you may be new to this whole situation anyway, and these allowances may be new to you. But what I'd say is, work out, does your income exceed your expenditure, right? If it does, do you have an adequate emergency fund for you to draw on? And if you do, then you're in a place where you've got surplus income, which can be allocated to one of these allowances, right? So if you're in that position, you should be allocating it to one of these allowances. What allowance that should be is going to come down to your own individual goals and objectives as to what this money represents. And that's where sort of me and Neil and, financial advisors in general can help you allocate those funds in the right way for a long-term plan. But, to start with, work out your income, work out your expenditure, and see if there's any surplus. And then we can start thinking about how to make the most of that long term.
Okay, so let's see if there's any questions.
How much does it cost for a full overview, review of my accounts, lack of usage of benefits, etc.? So, for me, it's all about, can we add value to your situation, right? So these initial conversations that we have, let's just see what position you're in. That's the way I've always worked, is to understand you a bit better, to see where and how we can help. Now, that may be just me giving you a little bit of advice for you to implement yourself. But if it's more formal than that and we enter into a proper advisor-client relationship, then, let's talk about what value we're adding and what costs come from that. But I think, as a starting point, if you would like a full review of your overall assets or contributions or allowances, then I especially, maybe Neil as well, are happy to do that, at no cost to you in that first stage.
It's worth just having that initial conversation. If there's nothing further to move on and you've learned something, then great. But the initial meeting you'll have with Josh and myself is more of an informal getting a feel. Can we work together? Is there actually work that needs to be done for you and for you to get a much better understanding? Now, one of the questions I've got here is about utilizing your partner's allowance. So if I wanted to make a contribution into my wife's pension, it would have to be seen as her making that contribution if it's a personal one. So if she isn't earning 60,000, it's the same rule that applies. If she's on a 30,000 or 40,000 salary, that would be the maximum she can make in a personal contribution, unless she is an employee of my business. And therefore, by doing so, we can use the carry forward rules and potentially make substantially more. So if someone's only earning 10,000, then my personal contribution for this tax year, even if I've made no contributions, is 10,000 for this tax year. However, if my wife is a director or an employee of the company and the company is in a position to make a substantial contribution, then we can go well beyond that 10,000.
So another question says, I'm taking my pensions and still working. what do I specifically need to think about? That's a really good question, because there's a lot to think about there. And I think the main thing to focus on is, what level of income do you need, right? Is that being achieved by your salary? If it is, then the question is, do we need to continue receiving an income from the pension scheme? If it's not, then of course, that pension scheme income is topping it up, and you're living your life through both sources. But if you are in a place where you're employed, you're taking in income from your pension, we need to remember that you can still pay back in to that pension scheme up to that £10,000 money purchase annual allowance. Now, your employer may already be making a contribution on your behalf. And if they are, another thing we need to think about is, am I exceeding that money purchase annual allowance, right? Because if you pay in over that, there could be some tax charges later down the line. So I think there is a lot to think about there. And just understanding where your pensions are, what level of income they're providing you. Is that a sustainable level of income? Safe withdrawal from the pension? Then that's what we can focus on.
So just building on that, slightly different situation, but when you're looking at your retirement, you've also got to look at your partner as well, depending on how you share your finances. But if you imagine you've come to your retirement, you need some tax-free cash for whatever reason, do you use the rest of your pension to buy an annuity, or do you go into drawdown? What Josh was saying there is also based on this. If your wife is earning X and you're earning Y already before you do anything with this pension pot you've got, is that enough for you to live on for this year or next? Because you don't need to go straight into buying an annuity, and you don't need to go straight into turning the tap on onto drawdown. If you feel you've got sufficient money coming in from whatever means you have, then it may be in your interest to delay taking further income from the pensions, because number one, if it's from drawdown, you get taxed at your marginal rate, and it gives you good flexibility of stop-start ad hoc payments. And once you buy an annuity, you're in. So if it's going to mean that it pushes you potentially into higher rate, you're going to lose a lot of that benefit. So as you get older as well, there's potential the annuity, if you buy it later on in your life, will be worth more. So it's worth getting advice and really planning out how this is going to look in a tax planning way as well.
Just another one, it says, can I claim tax relief for pre-taxed contributions to a pension? So by that, I'm assuming what is meant is contributions that haven't been taxed. So in that scenario, because there was no tax paid on the contribution, there will be no entitlement to relief, right? The relief only comes when tax has been paid on it, or if it's coming from a business as a business expense, because it's essential that the contributions going into the pension go in gross rather than net. So when it's gross, it means it's pre-tax, there's no tax been paid on it, and there's no tax relief due. And when it's net, it means you've already paid tax on it. Now we can start to claim the relief back.
There's also situations where if you have a sizable pension pot, you've utilised your full allowance for tax-free cash, is it still worth you making company contributions into your pension? It can still be worth it because it's still an efficient way of getting money out of the business. And it will also be dependent on when you come to retire, what sort of income tax you'll be paying then. Bearing in mind at that point, you're already aware, based on the size of your pension pot, that there's going to be an element of your pension where you're not going to receive 25% tax-free because you've surpassed that value.
Yeah, one more. I think this might be the last one. It says, is it possible to make retrospective contributions for the 24-25 tax year? So, no. In theory, yes, in terms of going back and utilising some of the carry forward allowance you have with your pension contributions. As this webinar is titled, Use It or Lose It, essentially from the tax year turnover, all allowances are gone. So you can't make any changes to your tax position in that previous tax year. But what you can do is your pension allowances carry forward, and some of the other allowances that Neil mentioned previously, gifting and those kind of things carry forward as well. and you can then utilize them twice, essentially, in the current tax year.
There's always every year when the previous year's back drops off. So if I made a 30,000 contribution out of my 60 for this year, I could still utilise part of that next year, but a previous year's contribution allowance will drop off while another one's being added, and that's rolling. I think we'll leave it at that for today, but I hope you all found that useful. Our contact details are on the invites, and we always welcome correspondence and open communication, even if it's just general questions. We're here to help. Okay, well, thank you everyone for your time today. Obviously, have a good end to the week, and thank you for listening to us.